Now, before I start this week's show, I'd just like to say a quick thank you to our podcast sponsor, Fidelity International. Now, Fidelity are one of the best-known investment platforms out there, and they're also a global fund manager responsible for around £320 billion worth of investments for over 2 million clients globally. Now, I personally use Fidelity's investment platform to run my own 80/20 investment portfolio, and that's for a couple of reasons. A, because they're cost-effective, and B, because they have access to ETFs, investment trusts, and unit trusts. For those of you out there who are looking for ideas of where to invest your ISA allowance this season, then Fidelity offer a range of guidance and fund shortlists, and they also offer fund suggestions from their investment director Tom Stevenson, whose name you may recognise because he also writes for The Telegraph. Now, you can find out more information about Fidelity and all of those fund shortlists at fidelity.co.uk. But for now, on with this week's show.
Hello and welcome to episode 207 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, how are you doing, buddy?
I'm good. I'm so excited at the moment, Andy. I feel like I'm podcasting all the time because, well, I kind of am. We did the Midweek Markets podcast yesterday, which again got some great feedback. I think people are really engaging with the contemporary money stuff of what's going on in the market. So I'm loving that. And the excitement of having all this new content we're able to push out when you're on board, when Lauren, who's already here, is on board. So yeah, I'm feeling good about 2019, and of course the Money MOT is out imminently as well.
Exciting stuff. We'll hear more over the coming weeks, won't we, about the Money MOT? We might even do a special, and we'll be talking about it as weeks go by.
Yeah, and what I want to do is I want to share on social media. Do follow us on social media because it's becoming one of our main channels now, so particularly Instagram. People will know I'm on Twitter a lot, often putting out some interesting content that I don't see in commentary and views that don't make it into the podcast or necessarily newsletters. So that's, again, very contemporary. But also on Instagram, we're having a lot of fun with it, but doing stuff on there that you will be able to influence what goes on in the podcast and other bits and pieces of Money to the Masses more. So, for example, one of the pieces from today's podcast, one of the main actual sections we're doing, was suggested by somebody on Instagram. I just put it out there on our Instagram story. What do you want me to talk about on the podcast? And someone responded, and here we are. We're going to do it.
Awesome. Well, you mentioned we're going to cover something that someone's mentioned on Instagram. So should we go straight into it? What have we got on today's pod?
Right. Today's pod is the first piece is about implementing a particular investment strategy called the all-weather portfolio. I'll explain more when we come on to it. I've also got something to do with tax returns because it's that time of year. You've got to get your tax return in by the 31st of January, which will be this week if you're listening to this podcast. And we're going to do the small piece on pensions. It's really just my view on something that somebody asked me that I didn't quite cover last week.
Great. What are we going to start with?
All right, let's go with the Instagram inspired piece. Now, this was inspired by somebody called Greenie20. I don't know anything more about them, but thank you for the suggestion. Now, the suggestion for the podcast was, how would you implement Ray Dalio's all-weather portfolio using index funds? Now, a lot of you listen to this might think, who? Ray? What? And let me explain. Ray Dalio was a billionaire investor and hedge fund manager who came up with this concept of an all-weather investment portfolio that was popularised by a guy called Tony Robbins, who's a bit of like a money guru in America. He fills out stadiums doing all that very American fist pumping and getting people to change their lives and imagining stuff. He also has made inroads. He's global, actually. He does a lot of stuff, and he's made some best-selling books, and one of them was called Money Master the Game. So Money Master the Game. And you'll find it in Waterstones and places like that. And in that book, he talked about Ray Dalio's all-weather portfolio. And what it is, it's a portfolio whereby it had been back-tested so that it would perform in all market conditions. So it's kind of that idea of perfection. So the idea of investment management, you would try and build a portfolio that would do well in most market conditions. So when, say, equities fell and equity stock markets all collapsed, then you'd have something else in your portfolio that would help lift things and counter that. So that's basically what we all know as diversification. So what is the all-weather portfolio and how do you implement it? Now, the all-weather portfolio, if you get a pen and paper, this is broadly what it is. It specifies the asset mix that you hold. And so adding up to 100%, you'd hold 30% in stocks from your domestic country. Now, in the popularised version, this will be in US stocks, but it could be in UK stocks. You'd have 40% in long-term government debt. So in the UK, that's gilt. So gilts that last sort of 10 years plus. You'd have 15% in government bonds that were more intermediate range, so less than 10 years maybe. And then you'd have 7.5% in commodities of some kind and 7.5% in gold. Now, that portfolio was back tested, and there were periods of time where it had obviously produced positive returns most of the time, but there were periods of time where it didn't. And one of those was in 2008, which is the height of the financial crisis, which I think it lost about 3% and a bit that year. But it became fairly popularised because of Tony Robbins. Now, the question was, how do you implement that? And the answer is you're going to have to go and buy index funds or ETFs because they're very cheap. And as we know, one of the key parts of investing over the long term is to reduce costs, because if you compound overpaying on costs, then it eats a massive chunk of your portfolio in the long run. So how would I do it? The first thing I do is go to Vanguard. Now, Vanguard Investor is the platform that Vanguard run, and they have incredibly cheap Vanguard funds. And it's actually, wasn't deliberate, but it's coincidental because the founder of Vanguard actually died this week. So the man who caused probably some of the biggest changes to the investment universe for consumers by allowing us to invest cheaply. And he didn't create index funds, but he certainly made it accessible to everybody, and it's probably saved billions in charges. He actually died this week. But I would go to Vanguard Investor and look at the range of ETFs and tracker funds they have. Now, you may want to go and look at the UK ones they have. They don't have the biggest range. There's about 70 on there that cover all sorts of assets like UK equities, American equities, bonds, and
when you say they don't cover the biggest range, about 70, broadly in the grand scheme of things, how many can there be, and where do they sit in comparing them to others?
Well, I suppose there is quite a broad range, but what you might think is there'll be, like most other platforms, like you say Hargreaves Lansdown, they have thousands of funds because they have everybody else's funds, whereas Vanguard only allow you to buy their own products. And of course, no fund house ever has that many products, and so 70 for a fund house is quite big. So Vanguard have in each area, so maybe the UK equity space may have 4 or 5. So when you add that up, it comes to about 70 odd. So they're really cheap. Some of the cheapest you'll pay in less than 2%, or maybe just around 0.2%, I mean.
And again, in comparison to the rest, when you say cheap 2%, what are we talking about?
I mean 0.2%, not 2%. 0.2% a year, you're looking at other funds that will be charging you 1.5.
Got it.
And that is very cheap. I mean, they are tracker funds. So you go there and you can pick equivalent funds that are relevant to the categories I said. Now, obviously, when it comes down to commodities and gold, Vanguard doesn't actually do those sorts of things. And I don't want to suggest a particular ETF. There's lots out there for those sorts of areas, because then I feel like I'm recommending a particular fund. But if you go to ETFS, they do a gold ETF, so it's a physical gold ETF. And one thing I would say, if you're going to try and recreate this portfolio as I've described, if you're going to pick ETFs, I would always favour physical ETFs over synthetic ETFs or sampled ones. So synthetic are ones that are made using various financial instruments to replicate the performance of, say, a group of shares, whereas a sampled one would be where they would take just, say, rather than having all of the FTSE 100 and owning shares in all of those companies in the right proportion, they may do a large selection, so it gives you most of that performance. Whereas a physical ETF will tend to hold everything in the right proportions, and they actually own it. So there's no what they call counterparty risks, where you're having to have a third party to rely on them to pay out the equivalent return. You've actually owning the stock. So all you've got to think is favour physical ones. So yeah, ETFS do a physical gold ETF, and now there are a range of commodity-based ones. iShares do some. Again, you have to be aware that you may not be able to get a physical one on all of the commodities, because commodities is a big basket. I mean, that covers oil, cotton, anything to do with farming and agriculture. So there are some that are broad-based ones, there are some are very narrow. So you're going to have to do a little bit of research around those, but it won't take too long to find some of the best ones on some of the platforms like Hargreaves Lansdown. My second tip would be, if you wanted to try and do a portfolio like this on a lazy way, then Vanguard, again, do life strategy funds, which I've talked about before. Now, they work by having a set percentage in equity. So let's say it was the Vanguard 60% equity fund. Now, the rest of the fund is invested largely in bonds, but they hold loads of Vanguard ETFs in various proportions. So they'll have US exposure in equities, global equities, they'll have UK equities, they'll have the same spread geographically in the bond part of the portfolio. So what you're getting is a kind of version of that Ray Dalio's all-weather portfolio in a roundabout way, not exactly, but you're getting something similar because what you've got is either 20, 40, 60, 80 or 100% equities based on which one you choose, with the rest being held in something that's less risky, that isn't stocks. So you could pick one of those, that's the lazy way, and they performed well. I mean, as I've pointed out to people, the one risk of those funds is that when the pound rallies strongly, which if you listen to this week's Midweek Markets podcast, the pound is starting to show some strength. If they rally strongly and the US stock market falls, then that Vanguard strategy won't work that as well, so it actually underperformed. That's why it's done so well, because the opposite's been true in the last few years. We've had US stocks being the best place to be and the pound crashing because of Brexit. Now, what I wanted to finish on with this piece is that I did a piece of research that this mirrors. It's quite interesting, really. A few years ago, I decided to do a piece of research for 80/20 Investor, which was to find the perfect ISA portfolio. So a portfolio that had made money in every tax year since ISAs have existed, which is going back to the year 2000. Could there be a portfolio that had made money in every single tax year and also over that period of time outperformed the FTSE 100, which is 100% equities, obviously? And in doing so, I came up with an asset mix which isn't too dissimilar to what Ray Dalio had, because what it found was you needed to have, I only end up having around about 20% in UK equities, but particularly equity income funds, so the defensive stocks. And the rest was really in gilts, and there was about 9% in cash. So if you want to know the exact percentages and how I did it, then you can get a free trial on 80/20 Investor. But what it shows, it was that bias towards domestic stocks and domestic government debt is what he determined was the all-weather portfolio. And coincidentally, completely separate piece of research, which I didn't even know or read about Ray Dalio's portfolio, mine showed a similar set of findings, which is quite interesting. So that portfolio, I've got to check what it did last year, because every year it'd been positive on my perfect ISA portfolio, but I think it was marginally, it might have been finished marginally down last year by like 0.1% or something like that. So I've got to check that, but that's pretty good, because even Ray's portfolio has been down about 3 or 4 times in its history, so I'm pretty happy with that. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service, let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
All right, Damien, we've got to talk about tax. It's it's the elephant in the room. We're looking at the date, and there are probably hundreds of thousands of people out there that are thinking, goodness me, I've got to get this tax return done. What have we got? What's this piece about?
This is about last-minute tax return tips, really, for people who are filing their tax return, and apparently 760,000 people left it to the last day last year.
759,999 other people other than me. Is that what you mean?
Yeah, but do you know what was interesting? There was another story this week I saw that basically the tax office had inadvertently started fining people for filing their tax return early, because there was a week and there was a glitch, and you normally get a £100 fine if you don't file your return in time. And something had happened. If you'd filed it on a particular weekend, I think it was the weekend before last, that those people started getting served with notices for penalty notices.
Wow.
It was a glitch, so they're having to unwind all that now. So yeah, if you're gonna, I was joking about it on Twitter that if you're a keener these days, you get fined. So maybe it is wise to leave it to the last minute. What I wanted to do was just mention one or two quick tips to people who are looking to do their tax return, because it's not the easiest thing to do. And the one, perhaps I should have done this the week before. I feel a bit bad now, because one of the things about the tax return system, people go, I'm going to do it online, but they don't realise they have to send away and do get the code, their unique taxpayer
and
reference.
Then if you've got a code but you forget it, and then you don't know your reference numbers and stuff, then they'll send it to you in the post, and it's a nightmare.
And I'm looking at you now and I'm thinking, did I mention it in a previous week? I hope I did. But anyway, if you listen to this and you haven't done it, it takes about 7 days. So you've got a £100 fine coming. Don't blame me.
You'll save them £100 in these next tips, though, so it's fine.
We might do, because one of the problems that people do is not claim the extra tax on pensions. And the reason that happens is because they will put in how much they pay into a pension, and they forget to reclaim the additional tax relief. Because if you are a higher rate taxpayer, one way you get that tax relief is via your tax return. And so what happens is that people don't realise that they assume their employer's scheme will reclaim that extra amount. So let's just give an example. You're a basic rate taxpayer. Yeah, okay, the 20% tax may have gone into whatever pot you've got. The additional 20% relief that you need, you're going to have to claim. And some people forget that you have to claim that. That's the first thing. But others also sometimes think that the scheme that they're in at work will automatically do all of that tax return element, that actually reclaim the tax relief, and they don't. So that's because a lot of schemes aren't what they call trust-based schemes. So if you think of a defined benefit scheme or some old money purchase schemes, they were. And so there was an element of those that meant that they maybe did reclaim tax. So what you need to do is, if you're filling in your tax return, check with your employer about the situation with any tax that you're paying when you're paying on pension contributions. Because if you are able to claim additional tax relief, then you need to do so. You can't rely on your work pension to do it. That's the default.
And double check what type of pension it is, because I did exactly the same, and then I realised I have a salary sacrifice pension, which you can't claim tax relief on because you're getting it at the front end, aren't you?
Yeah, so look at Andy. He's coming out the accountant in him. The payroll element is coming out in him there. So the other mistake to mention is that people they enter the wrong value of their pension contributions. So you're meant to enter your gross value of your pension contributions on your tax return. And so you've got to work out what that is if you don't know what it is.
Does that involve working it backwards sometimes?
Yes, everything you've paid in plus the tax relief at 20% on top. That's the contribution. Your pension provider should be able to tell you this if you don't know. So there's always double check, ring people up. They're ready for you to do this. They know what time of year it is. Just to highlight, if people are going to reclaim tax relief, then there is a section on the tax return which I'm going to just read this out. It says payments to registered pension schemes where basic tax relief will be claimed by your pension provider. That's the section that you need to complete.
Good. Any other tips on last minute tax returns?
Yeah, there is a tip. I've seen this one. This was quite a good one, actually. I didn't know the details of this, so forgive me if I sound slightly robotic when I read this. But I know there are people who work from home and they may want to try and claim back some form of expenses and that, and it becomes complicated. But there is a shortcut to doing it. And so for people, I'm going to read this out, for people working from home, you can use a flat rate of expenses at £10 a month for 25 to 50 hours a month, £18 for 51 to 100 hours, £26 for 101 hours or more. If you're using your car for work purposes and you haven't claimed it as a business vehicle, you can claim 45p a mile for the first 10,000 miles and 25p per mile thereafter. The point is, if at all that impacts you, then look it up and make sure that you are claiming that. I just want to finish on what happens on previous years, because there are people who thought they may have made a mistake. They've looked at things and included stuff in the wrong year, etc. You can actually go back and make amendments for the relevant years, and you can claim a refund up to 4 years after the end of that tax year, which is a little bit easier if you've actually done them online rather than via the old school paper way.
Oh, and I suppose, of course, if we go back to last week's podcast, we mentioned the trading allowance that you get up to £1,000 per year, which I didn't know about, and I'm going to be doing on my tax return.
Yeah, so allowances. Make sure you're using all your allowances. The married allowance that allows you to transfer part of your spouse's unused income tax allowance to you if you're a basic rate taxpayer. So that wraps up the tax.
Good. Pensions. What have we got?
Pensions. Now, I had a lengthy conversation with a pensioner. I can only call him a pensioner because I'm not being disrespectful. That's why what he called himself, a drowning pensioner, in fact. So he was asking questions about what happened with his financial affairs. His son was doing bits and pieces for him. He was a bit lost in terms of... Actually, I'll explain the story because it's anonymous. I'm not actually giving away anything confidential. But the pensioner, what happened, his son had run his money for him and he wanted an income. And his son had bought a whole range of shares, so direct holdings of shares for the yields. And of course the market has since crashed, and he's looked at that holding and he's now panicked because he's seen his portfolio drop from over 100,000 to probably about 90,000. And so that was the first instance. He was panicked, and he contacted me and said, what do I do? And obviously he said he didn't have the ability or confidence to run his own money. So that's the point when you go for financial advice. You need to pay somebody to do it for you. There's only so much you can do yourself if you haven't got the confidence. And then it's also you've got some comeback.
Again, not to be disrespectful to this particular listener, but it does surprise me throughout all walks of life and in all different parts of the finance world that people put so much trust in family members and friends, even though they've got no real qualifications. It's the trust who you know rather than trust what they know kind of thing.
Yeah, and I think that happens a lot. You get people who Bitcoin was a good example. Everyone was talking about these investments, they're making money, a friend of a friend, and that is how scams and frauds end up escalating, because they try and get other people on board because they think it's a great deal, and also to make themselves feel better. In this instance, his son was doing the right thing by his dad, which actually, in principle, what he'd done wasn't the worst idea. Now, bear with me, I'm not talking about direct shareholdings, because he had effectively put all the wealth into about a dozen holdings, which for me would be frightening. But what he was trying to do was actually build an income stream from the dividends that these companies pay out. And therefore, if you think about the way that a portfolio that's built to provide income, you actually get paid a dividend based upon how many shares you hold, not on their value. So if a company's performing well, they'll pay a dividend out, and therefore you get your set amount based on how many shares you have, and that's your income. So the current value of those shares are largely irrelevant if you're going to hold them forever and you're going to keep paying the dividend. Of course, the thing you're banking on is that company's going to be able to keep paying that dividend. They're not going to suddenly struggle and cut it. If in an ideal world they're able to keep paying it, then you were getting, say, across the board 5% yield. You'd get the 5% income that would be off of 100,000 when you originally invested. That would be £5,000 a year. You might be happy with that. So that I can see in principle. And the fact that the portfolio goes up and down in value shouldn't worry you. In fact, if I was going to be a retired pensioner and I wanted to get an income from a portfolio, a part of my portfolio would be in equity income funds, not shares directly, but funds, because they diversify across hundreds of holdings within each fund, and those individual stocks pay out a dividend which the fund manager collects and then pays a payout to the people who hold units in that fund. So in that way you can therefore try and get a sustainable income stream. So in that respect, it wasn't the worst idea. The principle of what he was doing I can get, but it was the fact he did it in so few holdings and directly in shares. And I got the impression that it wasn't his job, it was more of a pastime, if you get what I mean. It was a sort of something he did himself as he was a DIY investor. But the trick comes when if you're going to build a portfolio like that, is to try and find funds that have had a reliable history of paying out their dividends. Because what they'll do is they'll try and smooth those payouts in a way over time. But certainly they'll try and pick companies that have had reliable dividend streams. So what we did with 80/20 Investor, it's not a deliberate advert for 80/20 Investor, but we do heat maps that show you which funds have paid regularly over time and if that dividend is growing, because that's the other key thing. You don't want them just to keep paying the same dividend, you want it to grow over time, because otherwise, if you're going to retire for 30 years, the income needs to grow with inflation. That's why bonds don't provide the best income stream, because they provide a fixed income, hence the name. So a £5 every year for 30 years, that £5 not going to get you very much. Now, we moved on from that. So obviously, he should have gone and seek advice if he's not happy. It's not too late. He shouldn't necessarily just hold on to things because the value's down. He should get someone to look at it properly. But the principle wasn't that bad, what they were trying to do. Perhaps the execution wouldn't be what I would have done. So I gave him some comfort, really, to a certain point. But I was asked another question. I'm just going to read it out. It says, can I ask a straight question? If you were 80 years old, had a basic retirement income of around £20,000, had a cash fund of, say, £100,000, needed to allow for inflation and expected maybe to live to 100, would you invest in funds and stocks or play safe with a savings account that is subject to inflation? Think Great Depression at worst. He's talking about the Great Depression, obviously, back in the 30s in America, where stock markets plummeted. Now, the thing is, you shouldn't think you have to invest. If you don't feel comfortable and you're worried about things, you're going to be kept up at night, then investing isn't for you. Even if you're going to get less money, then that's just life. You want to be able to sleep at night and you're worried about capital preservation. I think there's this almost pressure from that people think that they are missing out. That fear of missing out drives them to invest in the stock market. If I was 80 years old and I had £20,000 worth of retirement income, which I'm guessing from the question he gets already, because he certainly couldn't get 20,000 from that 100 grand. He would only get probably at best about 5, maybe a bit more, 5, 6, depending on his health. Then I probably might put a bit in stocks and shares, but I would hold the vast proportion in cash, because he's saying he's going to live for 20 years. If he lives for 20 years and inflation, it's not going to erode. Inflation is at 2%. Then the value of your money is only going to halve after about 35 years. That's the way it works. So in that regard, I don't think he's going to have to worry so much about inflation. So cash isn't great, but I would end up looking for some alternatives, maybe some fixed-term bonds, as long as the banks were covered by the Financial Services Compensation Scheme. So I would definitely veer on the side of safety.
Good stuff. So as Damien mentioned at the front of the podcast, we do feel like we're doing almost podcasts every day, and that's because we have introduced the new midweek podcast, Damien's Midweek Markets, which I have to say, and Damien won't mind me saying this, the feedback on it has been incredible. So if you're new to this podcast, if you're interested in getting insight into the markets and what's happening, Damien explains what's happening in real time, what's happening in the markets, what it means for you, what it may mean for you in the future. And it really is a good insight and a good introduction into investing and doing it yourself, DIY investing. Damien, if people want to get in touch with you, how do they do so?
The usual methods, Damien at moneytothemasses.com, or Twitter, which is money to the masses with a number 2. But I would say, obviously, go on Instagram, money to the masses, the whole word. I mean, Instagram is where I'm living at the moment quite a lot, and we're trying to use that to influence what's on the podcast and shape what you want. And we're getting a lot of good engagement on there because, I mean, as much as we love to help and we want to help you, it's also great if you can help us by using social media, because it actually helps. What's the word, Andy, I'm looking for?
I don't know.
Pushes out. It ends up amplifying. That's the word.
Yeah.
Amplifying what we do. And the more people we have who know what we do, the more we can get out there and make money to the masses what it should be.
Good stuff. So, Damien, we're back on this very feed in just a few days' time for episode 3 of the Midweek Markets. And I'll be speaking to you with Damien next Sunday. So, thanks ever so much. Till next time.
Till next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Play. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.